Welcome to This Explainer. Okay, today we are going to act as financial detectives to figure out a really massive mystery. Namely, why exactly did the stock market absolutely explode to all-time highs right in the middle of a major global geopolitical conflict? I mean, it's a scenario that completely contradicts traditional investing logic, right? To really understand it, we're going to have to peel back the curtain on how modern market mechanics actually work. Look, we got to start with this glaring anomaly. A fundamental rule of thumb has always been that markets absolutely hate uncertainty. Yet, despite major airstrikes in the Middle East and the closure of the highly critical Strait of Hormuz, the markets didn't just survive, they hit record highs. This basically challenges everything we thought we knew about global stability and how it impacts your portfolio. If war is supposed to be bad for business, why on earth do stocks go up? So let's look at the timeline leading up to this. On February 28th, joint airstrikes were launched on Iran, and the Strait of Hormuz was completely shut down. Predictably, the market reacted pretty poorly. By the end of March, we saw a brutal 5-week losing streak, with the S&P 500 dropping nearly 9%. But then, we get the pivot. On the evening of April 7th, a ceasefire was announced. When the opening bell rang the very next morning, the market just ripped upward. The Dow climbed over 300 points, the Nasdaq jumped almost 3%, and over 400 names in the S&P finished in the green. Now, traditional financial media, they immediately slapped a label on this. They started calling it a relief rally, basically telling everyone the markets were simply celebrating world peace. But let's look at the actual hard data here. According to the maritime intelligence firm Windward, which uses AI to cross-reference satellite imagery and GPS, there were only 5 outbound carriers moving through the Strait of Hormuz by midday. Guys, that is a massive 96% decrease in activity compared to the pre-war baseline of about 130 daily transits. The underlying data proves the ceasefire was actively falling apart in real time. There was no real peace. So, what was actually moving the markets? To actually solve this mystery, we've got to rewind the tape a bit and look at Wall Street's underlying data right before that April 8th opening bell. Because while regular retirement accounts were quietly taking a hit throughout March, something much more extreme was happening right beneath the surface. Wall Street was in a state of outright panic, and hedge funds were positioning themselves for an absolute disaster. I mean, just listen to the sheer terror gripping the market at that time. Commodity analyst Rory Johnston pointed out that even in the best-case supply chain scenarios, if that strait remained closed, global demand would need to shed 15 million barrels a day. He warned this could push Brent crude to $250 or even $300 a barrel. He literally called the shock too large for the system to handle and predicted an economic state that wouldn't just be a recession but depressionary. Sentiment on the street was universally aggressively bearish. Which brings us to this absolutely massive number, 300%. We know exactly how bearish the street was thanks to hard data from Goldman Sachs' prime brokerage desk, which basically gets to see exactly what major hedge funds are doing behind the scenes. They reported that Q1 hedge fund selling in North America was the largest it had been since April 2020. Gross leverage was sitting over 300%. That is near an all-time high. On top of that, short exposure to macro ETFs, which basically means bets that the broader market is going to go down, hit the highest level since the pandemic. Wall Street was leveraged to the hilt, entirely betting on a crash. Okay, here's where it gets fascinating. The true mechanical chain reaction that caused the market to explode on April 8th is wild. The ceasefire headline was merely a spark. The actual fuel was a highly combustible market structure. What we witnessed was definitely not a celebration of peace, but rather 3 massive mechanical dominoes falling one right after the other. Domino number 1, a good old-fashioned short squeeze. You probably know the drill. When you short a stock, you borrow shares to sell them, hoping the price drops so you can buy them back cheaper later. But if the price takes up, say because a ceasefire gets announced on the evening news, you're trapped. To close your losing position or just to satisfy a margin call from your broker, you are forced to buy those shares back at a higher price. When a heavily shorted, over-leveraged market gets a positive headline, thousands of funds are suddenly forced to buy simultaneously. That forced buying artificially pushes prices even higher, which just triggers even more margin calls. But hey, the squeeze was just the warm-up. Enter the second domino, CTAs, or Commodity Trading Advisors. These are systematic trading firms running entirely on rules-based models. They don't watch the news, they don't care about geopolitics or ceasefires at all. They just blindly follow mathematical trends. Going into April, CTAs were sitting on a $30 billion net short position. But the exact second the market rallied from the short squeeze and crossed specific trigger levels, these mechanical algorithms immediately flipped from short to long. Over just 5 trading sessions, these blind algorithms unleashed a staggering $86 billion in buying pressure. According to Goldman Sachs, that was one of the top 5 buying speed prints of all time. Now, let's move to the third domino, because this is where things get truly wild: the options market. Dealers who take the other side of your options trades are required to stay delta neutral, meaning they constantly have to buy or sell the underlying stock just to keep their own books balanced. Financial data platforms flagged that going into the ceasefire, dealers were in what's called a negative gamma regime. In plain English, this is a highly volatile state where dealer hedging actually flips from stabilizing the market to actively accelerating the chaos. As those algorithms push the price up, options dealers were mechanically forced into a loop of buying more and more stock simply because the price was going up. So, a short squeeze, triggering a massive systematic flip by algorithms, which in turn triggered relentless options dealer hedging. That is what caused the rally. But here is absolutely the most crucial takeaway from this explainer. This mechanical chain reaction isn't some rare, one-off anomaly. It is a recurring pattern that has completely taken over modern finance. And we can actually connect the dots across multiple historical events to prove this. Just look back at December 2018. Stocks were crashing. Then Fed Chair Jerome Powell simply uttered the word patient, and the Dow exploded, gaining over 1,000 points in a single session for the first time ever. Or look at August 2024, when the Bank of Japan hiked rates. The yen carry trade unwound, the Nikkei crashed 12% in a day, and then mechanically bounced 10% the very next day. And then, of course, we have the fake relief rally we're analyzing today. The news catalysts are always completely different, but the mechanical market reactions, they were exactly the same. So you really have to ask yourself, why does this keep happening over and over? Well, the answer is that the very structure of the stock market has completely changed from what it used to be. The market of 20 years ago, the one dominated by human portfolio managers reading earnings reports, analysts carefully modeling cash flows, and real people debating discretionary valuations, that market is practically gone. Here is the crucial point. Today, a staggering 63% of all U.S. stock funds are held by passive indexers. We are talking about more than $13 trillion of blind money. This money does not read earnings reports. It genuinely does not care if a major tech company had a good quarter or a bad quarter. It simply buys the index on pure autopilot. And since most of these passive funds are market cap weighted, it creates this massive structural distortion. Basically, the bigger a company gets, the more of it these blind funds are forced to buy. This default allocation is exactly how the so-called Magnificent Seven tech stocks now make up over 33% of the entire S&P 500. A massive chunk of the global stock market just isn't being actively priced based on value anymore. It's just automatically absorbing capital by default. Now, what about the active investors that are actually left? Well, that whole industry has fundamentally changed too. It's consolidated into a handful of giant, multi-strategy mega funds. We're talking names like Millennium, Citadel, and Point72. Their assets have grown exponentially, and they operate using extreme leverage, typically 4 to 8 times their actual capital. And because they are so highly leveraged, they have to operate with incredibly strict drawdown rules. If a position drops by a certain percentage, they don't sit around in a conference room debating fundamentals or geopolitics. The computer simply sells the position immediately to manage risk. And underneath all of this equity trading lies the real beast, the options market. Same-day expiration options now make up around 63% of all S&P trading on peak days. Let that sink in for a second. We are seeing over $2 trillion in notional value change hands in a single trading session. Every single one of those short-term options forces a dealer on the other side to hedge their book in real time, resulting in immediate mechanical buying or selling of the underlying stock. So, what are we left with today? Basically, a giant cascading feedback loop. You've got algorithms blindly following trends, passive funds buying relentlessly on autopilot, and options dealers hedging in real time. The dominant players in the market today are not sitting around analyzing fundamental value. They are simply mechanically reacting to price movements. And when the price moves, their reactions just stack on top of each other, creating these massive, rapid surges or drops. So when we look back and solve the mystery of that April relief rally, the truth is actually incredibly clear. It wasn't about peace in the Middle East at all. The underlying shipping data proved the conflict was very much ongoing. The ceasefire headline was literally just the spark that ignited an over-leveraged, mechanically wired powder keg. As you navigate financial media, you gotta remember this. The headlines you see on TV are very often just the narratives people invent after the fact to help rationalize complex, mechanical market reactions. Which leaves us with a final, pretty vital question to ponder. If the stock market we used to know, the one about finding undervalued companies and investing for the long term, has been replaced by a giant feedback loop of algorithms and blind money, are fundamentals completely dead? Keep that in mind the next time the market swings and the pundits rush to tell you exactly why. Thanks for joining me for this explainer. I really hope it changed the way you look at your money.